be said is you're now faced with something that really offers people enormous opportunity. You're talking a 10 for 1. I think the space over the whole space over the next 12 years is probably 100x, right? That's a whole asset class. We've never seen that in history in that space of time. But humans are humans. We go back to that fundamental flaw is now humans have this propensity to fuck around with scarcity because they're economically incentivized to do so. Here they can't. So then they become economically incentivized to own this asset because it's scarce and it cannot be changed because it has this consistent supply curve and a limited number. So Bitcoin becomes this great store of value. And it would look like gold because gold's a good store of value. It's worked for thousands of years. But Bitcoin has this other thing to it. It's a network, which gold isn't, and it's technology, which gold isn't. So we have use cases and the benefits of building a network. So suddenly it goes up exponentially in price. Roll on to 2015, and suddenly somebody's looking at the blockchain and they start saying, imagine if these bits on the blockchain, which is where you record the ownership of something, in Bitcoin, it's Bitcoin itself. What happens if we could put a contract in there? Because humans live off contracts. You know, everything is basically a contract in our legal terms. And that was the rise of Ethereum. It became a platform where you could programmably change the blockchain, not the attributes of the blockchain. You couldn't remove anything off that ledger, but you could change the little holding buckets and say, well, it can look like this, it can look like that, it can adopt to this. And those things were verifiable as well, so they couldn't change. So this created Ethereum, which became the platform. So if you think of Bitcoin as this store of value, this very pristine, beautiful thing, then you think of Ethereum as also a very beautiful thing, but it's a much broader application because it's like programmable money. Of like owning a part of the internet. It's, as you said, I mean, everybody has to use Ethereum basically that uses this crypto rails, unless you're just in the Bitcoin world. But everything that we've talked about, and everybody will have, even if you're not very familiar with the space, will have heard the term DeFi or NFTs or tokens. Basically, most of that is still being built on Ethereum. And as you said, the network. So what is this Metcalfe's law that you and I have referred to? Metcalfe's law is, it really started to become understood in the 80s, and then much more so as mobile phone networks started, these giant connected networks, right? Because digital technology allowed networks to connect. Before it's humans, we couldn't connect with each other in the same way. So networks connect with mobile phones, suddenly they explode in value. You know, all these phone companies, huge companies on top of it, and they create network effects. Like the most classic example is Facebook. Facebook connects us with friends and family, and in exchange, they get your data, they sell you adverts, and so you've got a bunch of people using it, a bunch of businesses now building on it, and this advertising monetization structure. Shareholders get rich. You and I get to unfortunately meet somebody from university that we don't want to talk to, that we met 20 years ago, and we're now connected with again. You know, it's that. But the network that Ethereum and Bitcoin does is different. You're the owner of the network and the user. So as a user, like you said, with the NFT, you're actually owning a share of the network itself. So everybody uses it, owns a part of it. Therefore, if the network's going to get used a lot, you're all going to get rich, and the value of the network is going to go up massively. And the more people build interconnections, so the Metcalfe's law is not only just the number of nodes, i.e. the number of users, but how much they connect with each other. Well, you're seeing it because there's NFTs and there's DeFi and there's all of these applications, or the store of money aspect. These things all together, and then there's the linking of all of these, like Chainlink or some of these other protocols, Polkadot. They're linking all this ecosystems together. So I can send you $1 instantaneously, and we have no idea whether it went on Bitcoin rails, XRP rails, Ethereum rails. And guess what? We don't care. I promised you $1. You want to get the dollar instantaneously. That's interoperability. That's all coming. So this is what Ethereum is about. It's the magnitude of this network where everybody's developing everything on top of it, and it's scarce supply. So it's seeing an even faster adoption rate than Bitcoin now, for the reasons that seem pretty clear, because it has more use cases than currently the Bitcoin blockchain does. Doesn't mean Bitcoin blockchain can't in due course, but right now there's a lot more use cases in Ethereum. It's super exciting. Value proposition stands above all things. It is pristine, it's pure, it is what it is. And the way it's so impossible to change any of the attributes of Bitcoin makes it a bit clunky. And that clunkiness is its beauty. It is so secure. It's the most secure of all protocols. So let it be what it wants to be. Now, people are building things like the Lightning layer, which allows you to do lots of fast payments over the top. Maybe that scales. Maybe it doesn't. Doesn't really matter. That store of value for every person to think of, like it's owning a piece of Manhattan real estate at low prices, that's never going away. Not in the conceivable future, because humans have now said it has value and it's being adopted very fast. So no, Ethereum's a very different thing. It doesn't compete. That's how I like to think about it. And unfortunately, when you go online, people will tell you, well, it's competing and it's not as good. You have to ignore all of that and look at the whole space overall and say, and just be honest, saying, we don't know where this is going to be in 10 years' time. And like you say, so therefore I can own 3 of these things. And probability is I'm going to capture a large part of this, and maybe I'll adapt in due course. I think it's part of it's my background. My father's a first-generation immigrant from India. My mother's a first-generation immigrant from Holland. They met on a blind date in Birmingham in the UK. I've lived in India. I've lived in Spain. I grew up in the UK. I've lived in the Cayman Islands. I've traveled the world. So it forces you to be open, because you've got different religious backgrounds there. You've got massively different cultural backgrounds. All of this stuff forces you to be open-minded. So I'm generally open-minded by nature, just because of that. And macro investing is all about being open-minded to other possibilities. So once you learn the trick that it's okay to say you don't know, but I think this might be how it plays out. So you think in what's known as probabilistic terms. Then for that to happen, for you to say, look, I think there's an 80% chance that Bitcoin over the next 5 years is going to $250,000. That's a reasonable odds. What's the 20% chance that it doesn't? Okay, so you need to have both of those things in your mind at any one stage and be assessing them. I learned that from the book, I think it was The Alchemy of Finance by George Soros, who was probably the most famous of all of the macro investors. And he would talk about this a lot, that you have to have these kind of logic trees of probability trees. And once you understand that, you can even bet against yourself, which is really hard to do, and I can't do it. But some of the best traders can be, long the S&P. They think the S&P is rising, but then they think the odds of it falling are getting higher, and they start selling against themselves. It's like, it's very hard to do. But that kind of investing teaches you to keep an open mind, because you're looking at the whole world, and you have to know that we don't know the outcome. And anybody who tells you that they know what's going to happen, it's just a fraud. The narrative of entrepreneurship is start thing in garage, borrow money off parents, or start it on your credit card. 3 years later, billionaire. Right? That's the narrative. And then you write your book on how I manage my company. Right? That's actually not true. The best book ever written on this is Ben Horowitz's The Hard Thing About Hard Things. What you have to do is battle both your assumption, as you say, and test it endlessly. You have to be paranoid, excessively paranoid, but still confident in that you're right. And you also have to accept the risk of failure, because the moment you accept the risk of failure, which is very high in startups, you'll start hedging against it. Once you stop worrying about failure as the narrative, you tend to attract it. It's a really difficult thing. People who fear failure above all things tend to fail more. People who don't look at failure and just look at the moonshot tend to fail too. It's the people who can see failure as a wolf behind them and the testing of their ideas, but still having the conviction and maybe changing paths because the wolf is catching up. They tend to fail less. But it's hard, makes you feel sick. You don't sleep at night. And that's the beginning of Ben Horowitz's book basically is 2 pages of what that feels like. It's called The Struggle. And The Struggle is probably the most profound 2 pages in all of entrepreneurship. And it's true. And it's hard. The mythology is investing is hedge fund manager George Soros spots the opportunity, gets in at the right price, makes a fortune. The reality is most people have no idea where the price is going over a short term. So what happens is you buy something, you put all your money in, you've saved up your $5,000, you put it all into Bitcoin. Bitcoin falls 50%, you panic, you sell it. You feel terrible. Bitcoin goes back up again. You feel even worse now. You can scrape together. You've lost half of your money now, and then you keep compounding these errors, right? It's called market timing, and market timing is extraordinarily difficult. I do some market timing because that's been my job, and 30 years I've done more than my 10,000 hours, a lot more than my 10,000 hours, and that doesn't make me very good at it either. I'm not bad at it in long-term investing. I'm terrible at short term. So what is dollar cost averaging? Dollar cost averaging is basically what everybody does with their 401k. The problem is with 401ks or retirement funds is nobody cares about them. You don't know what's in it. You have no ownership. You just put some of your salary away and it goes in this mythical thing that you probably assume won't be worth as much money as you hope it is. That's what that's become. And you put it in every month. Why do you do that? Well, because you're averaging all of the highs and lows over time, because markets tend to do this. So you're kind of indifferent. In fact, you love it when it falls because you're buying more units at a lower price, because your game is to own as much as you can at the lowest possible price, a beautiful price over time. And had you done that in the S&P or anything else, you make money. Now, what's so lovely about Bitcoin is it's not a passive investment like your retirement fund, because a retirement fund you can't access until later. So you kind of write it off, and everybody's heard that it's never going to be worth as much as it should be anyway. So it's become a bit of a pain as opposed to something. But this you own, you live and breathe that volatility, and you live and breathe those gains when they happen. And you will be like wide-eyed. I did it to my sister-in-law, forced her to do this. I said, listen, I'm going to make it easy for you. Just go and open a PayPal account and start that way. And she had some savings. She could take out of another thing. She had like $5,000, $10,000, and she put it in, and we got the timing relatively right. So it shot up a lot. I think she got in about 13,000 in Bitcoin.
Whoa.
And it shot 17,000. Yeah. And it shot up a lot. So she's like, wow. And then it falls a lot. And she's calling me up saying, what do I do? Should I sell some? I'm like, no, you keep putting in part of your paycheck. And after all of these falls, these several falls, she starts to really understand. And when they start falling a lot, she starts doubling the amount that she would have normally invested. And now she's taught herself to invest. Next thing I hear, oh, well, I bought some Ethereum. And this is how I'm dealing with that. So she's now looking at 2 different things. And she's now thinking about the asset allocation. What's going to outperform Ethereum? It's big. She knew nothing about this stuff. This is a year and a half. And she now understands, because of that dollar cost averaging and taking ownership, that you, exactly as you said, once you actually own something, that 401k, you don't actually really own. It's like some other guy does something with it and hopefully he makes money. This is you. You're taking responsibility for your own finances. That's so empowering. To be said is, you're now faced with something that really offers people enormous opportunity. You're talking a 10 for 1. I think the space over the whole space over the next 10, 12 years is probably 100x, right? That's a whole asset class. We've never seen that in history in that space of time. But humans are humans. We go back to that fundamental flaw is we love leverage. So let's say you had borrowed to buy the original Bitcoin purchases. And let's say you put down half of the money. You'd have been wiped out. And you'd have had to pay somebody and you'll have been liquidated. And then Bitcoin goes back up in price and you'll have missed it all. That's what leverage does, because it's okay in a house because house prices aren't very volatile. So occasionally, once in a generation, you get a 2008 thing where the house prices start moving a lot and suddenly the people's equity in their house wasn't enough and everybody gets liquidated, i.e. the bank says, we want our money back. That's okay to take that risk if you're cautious in housing. In crypto, this thing moves around like this. Its predictability in the short term is extremely low, unlike housing predictability. So just don't borrow money to do this. If I can get that across, then you don't care if it falls to 26,000 or 10,000, because you can buy more units at the lower price over time and you don't care. And then when it's trading at 500,000, you'll have become extremely wealthy. It's as simple as that.